per month, then yes, next year you could see prices come back because it's going to overshoot. So what happens in Australia basically is you see prices surge when demand is often artificially influenced. It can be influenced by a mining boom or overseas buying or rapid drops in interest rates, or in this case, some rapid drops in interest rate, JobKeeper type incentive and a home builder incentive, which has pushed the market forward, coupled with a lack of supply. And that supply has largely been contracted, not because people gave up selling homes or they didn't think they were going to get their price, is that COVID just stopped that.
Yeah, so I think, so today really it's probably about like, there's a lot of noise about the property market. One day it's going up, one day it's going down. What I like with a lot of the stuff that you do is there's a lot of data and thought behind it. So yeah, like I think today hopefully we'll cover off on that, like which way you think it's going to go, maybe some predictions, and yeah, let's dive in.
Okay, so let's start from a bigger picture. So the first two things I want to talk about is interest rates and HomeBuilder. HomeBuilder I know is now finished, but it's extended in terms of its time frame and its application. And it's not a small thing, 76,000 people have to date, well, that was as of middle of March, took up a HomeBuilder incentive. Most of them built a property. And a lot of those were first home buyers. So it's had an impact on the market, which we'll talk about. Interest rates being low have had an impact. And we'll talk about population growth. And then we'll look about some wage things, because wages is a major driver. Long-term wages drives price growth. And then we'll have an outlook about what's happened over the last 120 odd years with prices in Australia, and what I think is going to happen after this current upswing, boom, if you want to call it that. So let's talk about interest rates. So I'm just going to flick a few slides up here. First of all, this first chart shows us price growth since 1990 to date, with a question mark about where it goes. This is the annual change in house prices in Australia. So it's Australia-wide, and it's houses. Houses still make up 70% of the market, so houses are a good broad indicator. And you can see there's two colours dotted on that chart. One shows where the Reserve Bank has changed the cash rate, and that's the blue dot, and that's where they've increased it. So first of all, you can see when the Reserve Bank does change the interest rate setting, in other words, when they're rising in this case, you can see that price growth falls. So the market overall is influenced by the cost of money, and not only its cost, but the ease in which money can be actually lent to somebody. And at the moment, it's somewhat loose. So not only is interest rates low and record low, but also the criteria in which you can borrow is quite loose. Whether or not that stays that way, I question if it will. So it's easier for people at the moment to borrow money, and the cost of that money is low. I don't think that cost is going to go up dramatically. I think interest rates will rise. We'll talk about that in a second, but it's not going to go to what it used to be. The beginning of this chart, whereas roughly where I bought my first property, interest rates, the cash rate was 17%. Now it's, 0.1%?
Yeah.
So in that chart, you've gone from a very high interest cash rate and interest rates to very low. And of course, the Reserve Bank is printing money. They bought bonds. They bought $100 million worth of bonds in the last cachet. So they're also keeping interest rates low. We'll talk about why they buy bonds in a second. The other part of this chart, which is more telling at the moment, is the red dots, and that actually shows interest rate reductions. And you can see that when they have those, and particularly when they have a collection of those, the market responds by prices going up. So when money becomes cheaper, people in Australia do actually often buy real estate. It's often residential, it's more often houses than not. And that activity, that increase in demand, particularly if it coincides with a lack of supply, increases the price. And that's definitely what's happened now. You've seen more people staying at home over COVID period, and that has focused the attention more on the home. You've also seen interest rates fall. You've seen some incentives, not only HomeBuilder, but JobKeeper and to some degree JobSeeker. Again, both finished, but they actually kept the market buoyant. JobKeeper was quite successful in terms of keeping the economy running. And you've also seen a very tightness in supply. It's about 17-18% less supply at this stage than there normally is at the beginning, first quarter of the year. Now that could increase, and I think it will increase as prices rise, and a lot of potential sellers say, hey, I can get the price that I want or more. Let's actually sell the place and downsize, change, move, whatever they want to do. So that's going to change. So right now the demand's quite high and the supply is pretty tight, and hence we're seeing, monthly price rises of 2 to 3%, which hasn't really happened since the late 1980s. And we'll talk about that in a minute. So that chart's a good one. It indicates, by the way, it took a lot of bloody effort to draw those dots on that, find those where those dots go, but it's a good chart to show what happens when interest rates go up and down in Australia, vis-a-vis prices. The next chart shows, it's a little technical, but we'll go through it quickly. This actually shows the bond yield. Sometimes in the financial pages of the papers, particularly the Fin Review and the Australian and the like, you'll read about a bond yield on occasion. It's usually in the weekend editions when they want to write about those things. Essentially, what this means is the cost of short money versus long money, and when it's over 0.5%, in the past, and I believe in the future, you're going to see the cash rate rise. So you can see up until the 17th of March was when I updated this chart. You can see that the bond, the yield is in a very positive movement. So it's likely that somewhere in the future, interest rates will rise. The cost of money is actually increasing. That's basically what it shows. When it's below that line, you actually see that interest rates have fallen. So if you went back to the previous chart and looked at this one, and I have a chart that shows where interest rates went up and down, but I haven't put it on here. But it's likely that interest rates will rise. Now, what's happening to stop that is that the Reserve Bank is buying bonds to actually bring back the cost. So they're buying the market to bring it down. You can see a little squiggle at the end moving down a little bit. So somewhere in the future, I suspect after a federal election, I'm not convinced that it will be next year. I think that it'll be after the football, so October, say this year. I think it'll be quite a close election. I do think that the government will not, whilst it's the Reserve Bank's decision, it's more of a Chinese wall. The government will actually keep interest rates, and the Reserve Bank will keep interest rates where they're setting. I do believe there'll probably be some incentives running through the market in marginal seats to do with housing affordability and or maybe an extension or another grant in some description, particularly first home buyers. I also do believe that when they can, and I think it'll be, despite the vaccine rollout being a somewhat stuffer, I think it'll be the latter part of this year into early next year that they will increase migration back to Australia. And that increase could be higher than the previous intakes for the last couple of years prior to COVID, because I want to drive demand, particularly as HomeBuilder finishes, and there'll be a large hole in the market. Again, 70-odd thousand people took up first the HomeBuilder demand. That's half to 2/3 of the annual demand in terms of building in Australia. So there'll be a hole somewhere in the next 12 to 18 months in terms of building, and building makes up about 15% of employment in Australia, indirectly with all the hanger-oners, which includes us too, in broad terms. That's up to 25 to 30% of jobs in Australia is because somebody builds something, mainly houses. So its economic impact is quite large, and so they have a lot of pull. So I do think you're going to see an increase in immigration to Australia in the future, and that's good. It's not good if you live in the capital city and you've got to put up with traffic and all that type of thing. But it's good in terms of that's another thing that lifts demand. So I can't see prices necessarily crashing as we hear about. I think there's a plateau, but we'll get to that. one of the things that HomeBuilder has done is it's seen a lot more first home buyers actually buying new property. In interesting sense, not so much HomeBuilder, but the state government incentives to encourage first home buyers to buy something new over old. That started in about 2016. You've seen a large proportion of people who buy a new home. First home buyers who buy a new home is rising. I've always been of the school that if you bought your first home, you buy something that's older that needs actually a fair bit of renovation. You know, we did that several times, my wife and I, over 30 odd years we've been married. Well, we have been married 30 years already. And you know, because it's capital gains tax free, you renovate a home, live in it, on sell it for more money and do it again. It seems to be that the incentives in the market, particularly not only bank of mum and dad, but helping with deposits, but also state government and in the home builder sense, federal government incentives have been quite attractive for first home buyers to buy their first home. Less upside in terms of opportunity to renovate and improve and move on. But the deposit gap, I think, is important. So it shows that housing is somewhat unaffordable. We know that. And any help that the first home buyer can get with the deposit in initial phases of the loan period obviously is important. So that's another thing that when it comes to a tight election federally, I think you're going to see some incentives run through the market. I don't know if that will definitely happen, and I don't know how large they'll be. And if you're a first home buyer and you're listening to this or are going to be a first home buyer soon, I wouldn't necessarily wait for that, but I think it will be there. Keep it going? Yep, happy with that?
Yeah.
Okay, let's talk about some population stuff. Just quickly, here's a few things that I've grabbed from somebody else, as we all do. This stuff comes from ComSec and some of it from the ABS. So you can see that the first one shows that, yes, we are seeing population falls. That's because we basically shut down migration. Migration makes up 2/3 of population growth in Australia. Second chart shows that in terms of the migration slides. Overall, we've seen population growth drop. And what's happened during COVID, but is also a trend also happening, is the birth rate in Australia has been declining. It does peak, and it did peak in the up to 2009, you can see, and that's because we had a baby bonus that the previous Liberal government gave out, and that is now sliding. And one would have thought that if you were locked down and you actually kind of liked the person you were locked down with, you could have had a child. And I know a few COVID children. There's a couple who live in our street, but most people have said economically uncertain. I don't think we'll have a child. Interesting how many divorces actually will come out of COVID. But so one of the things that again leads to the demand in Australia in the future is we're going to see a continuation of migration in terms of to keep the population growing or even to keep it stable. And many listeners might say that, oh, well, I'd like to see less people here. Well, the economy largely doesn't want that. I mean, Australia's economy is driven by three things. It's an expanding market, which is population growth. We can expand and also have more wealth and more spending. And that is happening in some pockets, but overall it isn't. It needs bums on seats. And it also, that's about 1/3 of the demand. 1/3 of the economy is driven by borrowing money, so debt, and the other 1/3 by productivity, us doing things better. I think I'd like to see a lot more of the economy being us doing things better. And the changes that's happened recently with China and the trade embargoes and stuff going on, shenanigans, has actually seen a lot of industries, not so much the government, a lot of industries say, hey, we have to either find a new market, we have to do things a little better. So that's been not painful, but I think encouraging. So these charts basically said that population growth slowed down. And despite that, we've seen building activity at record levels, and that's mainly to do with HomeBuilder. So it's going to create a hole. That's all I'm getting at. This quickly shows that migration to Australia is a net figure, so people leave the country and people arrive, and the departures have been rising, and the net migration in recent years has been falling at about 4,000 people per week. What I think will happen once the borders open is not as many people will leave as they have for a couple of years, because Australia is, a lot of people have found that Australia is not a bad place and they've holidayed at home, and they're also concerned about travelling and being, changes and being not allowed back into the country, which is not a good thing. I think Australia could have done better there, but such is life. But we're also going to see an increase of more people wanting to move here, and not only from the old Dart and parts of Europe, but increasingly from parts of Asia and especially Hong Kong. And if the Australian government, which I'm sure they will do, is encourage migration from Hong Kong, a lot of those people will move here. They will bring a lot of potential business with them, and they will also push the market in terms of price, because what you can buy in Hong Kong for a couple of $1 million will go a long way in Australia. So they will come with a different mindset of purchasing property here, and will help keep at least prices stable into 2022, 23, 24. I believe it'll have a positive impact, particularly in Sydney and Melbourne, and to some degree in parts of southeast Queensland. Now, they will bring a lot of business with them. I've read figures that for every 250 to 500 people from Hong Kong, potentially they'll bring $1 billion worth of business. Not overnight, but as through their life cycle in Australia. So a lot of people who will migrate won't necessarily, will be the more well off, and they will establish businesses and bring business connections here. So that's a negative impact, not only from the human point of view, but from a market point of view, economic point of view, of what's happening in Hong Kong vis-a-vis China taking over. So that could be a very positive thing for Australia. The other thing that's quickly I want to mention is that we read a lot about internal migration and how the population is fleeing to regional towns and so forth. That isn't necessarily true. There's been some reports along similar lines to some of the things I've been writing in recent months, which is good. So this chart basically shows us the change in population growth outside of the capital cities as defined by the ABS, and the grey line shows how it's increased, so more people are moving to the regions by default. But a lot of the red line shows actually the real movement outside of the capital cities' urban areas. So what the ABS does is they think that the Gold Coast and Sunshine Coast, or Newcastle, or Wollongong, or Blue Mountains, or Geelong and Ballarat and Bendigo are outside of, say, the capital city influences, where we know that a lot of people commute daily. It's not pleasant, but they do that from those locations, or they catch a train from the Gold Coast to Brisbane, or they travel from Toowoomba or the out parts of Toowoomba to Brisbane. So when you factor that in, there has been an increase to those outer suburbs, but they haven't necessarily been to regions. One of the things that's driven the population growth, in inverted commas, to the regions is that people just haven't moved. So this basically chart, the second ones particularly, show that the number of people who haven't moved have stayed in a regional town, Mackay, Townsville and so forth, who normally would move to a capital city for work or lifestyle, or just to get away from mum and dad. And they're usually in their 20s to early 30s. They haven't moved. I'm not convinced. And there's several other people of I was going to say my intelligence, smarter than I am, I really should say, also believe that once restrictions are eased up, and it's already starting to see it happen in particularly southeast Queensland, they are moving back to where the jobs are and where more opportunities are, and where it's more, inverted commas, funky, if you want to call it that. So they're already starting to move there. So be careful of some of the stuff and rushing off to a region. It's very topical. It makes good headlines, but young couple walking down, Cairns or something like that. I'm not having a go at Cairns, but a lot of the growth and population growth still takes place in and around the capital cities. It might be might be less in the short term to an inner city or middle ring suburb, but not necessarily neither. A lot of those people moving from interstate, and that's definitely happening in southeast Queensland. They are moving to the Gold Coast, Sunshine Coast, or an outlying area, because to them, living west of Sydney or living west of Brisbane, is definitely better than living west of Sydney. And I'm a Sydney boy, and I grew up in the west of Sydney. And let me tell you, what happens in the west of Brisbane is far better than what can happen in terms of what you can afford and the experiences that you have traffic-wise. And even it's going to sound a bit nasty, but there is some xenophobia involved. So, where a lot of these migrants move to, it has a less multicultural feeling than where they've moved from. And for some people, that's important. So be it, such as life. Okay, let's talk quickly about wages, and we'll talk about the future. One of the things that is happening in Australia, and is happening across the Western world, is that annual wage growth is low. It's got little to do with inflation, in my opinion. It's more to do with the nature of work and how things are changing. You're seeing a lot more jobs, and COVID's accelerated this in terms of services and access online and so on. You're seeing robotics, you're seeing digitalisation, you're seeing the Internet of Things affecting work. And as a result, wage growth might bounce around, it might go up a little bit and so forth, but I think we're going to see, gone are the days where we're going to see 5+% wage growth per year. Now ask yourself a simple question: are you going to if you work for yourself and you employ people, are you going to pay them 5% more next year for doing the same thing? And the answer is no. And if you work for somebody, you might see pay rises involved in some form of incentive, target, so on, cost savings that you bring, but generally, just to keep you, they're not going to pay you more money. And it's more competitive. And those people who think they're going to work from home, and I think there will be an increase from working from home. I mean, I'm working from home, but I've worked from home for 5+ years. And I work with others, and occasionally I employ others, but working from home is not an easy thing to do. It often takes more discipline than you think. And the irony is you often work more than less if you worked in an office. It's turning office a key thing. I have an afternoon snooze, so I'm at that age where you do those things, and so on. So wage growth's basically not going to increase. So you've got to be careful when you're taking out a large loan, particularly if it's your first time doing it. Don't spend money anticipating of earning it. You've got to be careful about what you borrow. And the next thing is a little scary, and this actually shows the wage growth by income level and the number of jobs by income level based on the type of work that is forecast to happen in the next 10 years. So let's go back 25 years ago. Middle income, this is individual income, and I've made these into today's dollars. Middle income, somebody with earning $85,000 a year, that's a gross figure. That's 50% of the employment in Australia was that type of thing. So the middle Australia was an expanding thing and drove the market. Then in the last 5 years, a lot of the jobs were created were middle income or low income. So people earning 55,000. So they worked in tourism, they worked in retail, they worked in services. Some people earned more, but a lot of people didn't. And then in the next 10-year period, a lot of the jobs that it forecast are going to be lower paying jobs. And if you went to the region, 60% of the jobs are supposed to be lower paying jobs, and the higher incomes are about 25% in the capital cities. So this is an Australia-wide quick chart. Now this, if you're an investor, this is an important chart. It shows that you can't keep on increasing rents, and the key to getting more yield is to have more people in your property paying you, say, $200 a week, rather than having a family paying $500 or $600. If you can get 3 or 4 people, particularly 4 people in there, whether or not they're a couple or not, but paying $200 a week and it works, you'll get a higher yield. Might be a bit more wear and tear on the property, but there's a limit to what particularly a rental market can pay, because they're not going to earn as much money. And you're seeing in Australia household size increase because it's more a multi-generational household. Only about 5% of the properties in Australia cater well for multi-generational homes, where the existing market's about 15%. And I think it'll increase, like it has overseas, to about 20-25% the next 10 years. So in other words, people are living with their adult children at home, they're living with their grandchildren at home, or they're living with their aging parents at home. And COVID's probably pushed that a bit more. Not that many people are sending off their oldies to aged care home and something like that. They're looking to accommodate them in their property. And if it's your mother-in-law, your outlaw, it's best maybe not in your house, or it's not necessarily the same entrance, sharing the same place. So you want those to be a granny flat underneath the house, built to the side. That's why dual occupancy homes are increasingly in demand, particularly in new subdivisions. And that's why the backyard home movement has seen some acceleration. And a lot of people have been purchasing properties that they can build in underneath, improve with a separate access and so forth. And that's worth considering. Even if you're a first home buyer, how can you get somebody into your property to help you pay the mortgage, particularly if interest rates rise? Again, I don't think they're going to rise much, but they'll rise up to 1% probably within the next year or two. And I know that's not what the Reserve Bank says, but it'll probably be taken out of their hands because the banks will increase interest rates. And they're already doing it on the longer money. They reduced their shorter money, the under 2 years slightly, but they're increasing the longer money because that bond yield chart we showed earlier. So you're going to see, I believe, less income. Of course, the people with wealthy are earning more money and they're actually buying more assets and they're controlling more of the wealth, but the majority are earning less money in terms of new jobs. And if you're here listening and you've got adult children, you know that even if they've got a degree or two, they're often working 2 or 3 jobs. And even if they've got the job of their choice, it's difficult to make ends meet, particularly if they're starting out. And so they might be doing something barista on the weekend or still living at home on your dime, which is a reflection that, maybe they can have sex at home, but also, but because that's often, I left home because, 18, and I didn't want to be at home because there was no way a girlfriend was staying in the bedroom, let alone the house. And these days it seems to be quite different. Anyway, so income's going to be less. So let's look about the future. Now here's a chart that I have, taken from somebody. It was too hard to draw. Oh, you've gone too fast.
Oh, sorry, I was trying to move that so you could see that bit.
Yeah. So this chart basically shows real house prices in Australia from 1990. What is the real house prices? Is that they've actually been made into $2010. I'm about to update this chart to bring it up to date, but it will show the same pattern. So what happens in Australia basically is you see prices surge when demand is often artificially influenced. It can be influenced by a mining boom or overseas buying or rapid drops in interest rates, or in this case, some rapid drops in interest rate, JobKeeper type incentive and a home builder incentive, which has pushed the market forward, coupled with a lack of supply. And that supply has largely been contracted, not because people gave up selling homes or they didn't think they were going to get their price, is that COVID just stopped that. So the lockdown stopped the rolling stock. Now that's starting to increase. There's an expectation that the amount of stock on the market could double in the next year or two. Now I think that's a little wild call, but if it starts to increase, and work by SQM Research and others are showing that their regular surveys is that it is starting to increase, then you'll see more competition in the market, and that will slow down price growth. Keep in mind, I believe you're going to see overseas buying when they can come back, and you're going to see migration increase, and you're not going to see rapid increases in interest rates. And we've got a pretty tight election coming, so you'll see some incentives. So if the current market increases by 1 to 3% per month, then yes, next year you could see prices come back because it's going to overshoot. I suspect that you're going to see some macro-prudential controls in the latter part of this year. Again, that will be timed around the federal election, and more likely will happen after an election. Assuming that the election is later this year, then you'll see that in the back half of this year, and that will slow down demand, and the ease of borrowing will actually become harder. Between now and then, it's probably going to remain roughly what it is. There will be some increases in supply, so that the monthly price growth will be less, but I think there will be price growth. Then post next year, assuming that it doesn't get out of hand, we don't see prices leak by 10, 15, 20%, but they go up by, say, 5, 10% at the end of this year. We're likely to see a contracted period, I'm thinking a decade, of not much happening in terms of price growth. And then you can see that in those red lines, whilst there's some bumps and so forth, essentially over those periods of time, you see not much happen in terms of price growth. They plateau out. And that's been my forecast for some time, that after we see this current surge, none of us expected the surge that has happened. I wasn't calling for price falls last year. I was saying that home is where the heart is, and you're going to see that shore up values in Australia, because a lot of the Australian economy, a lot of the wealth in Australia is tied around one's home, and they're not going to give that up, particularly where you say, well, if I can't stay at home, where can I stay? But I didn't expect the prices to show the strong leap that they've had, and very few people did. But having said that, there's a fair bit of evidence around that post an increase in what we'll call a boom, you see prices plateau out, and that can take up to a decade. So the latter half of 2022 to 2028 to 2030, I think you're going to see a pretty flat market. But prices will increase between now and then. So if you're an investor, I think looking for a yield is quite important, particularly if it's your first investment property, because interest rates are likely to remain low against historical periods. So getting a return of 6, 7, 8% gross is going to be quite good. That'll net back to 4 to 5%, which would be better than the cost of money, one would think. And then if you're a first home buyer, buy with your eyes open, but keep in mind that the price growth period that you're entering in now, that's atypical. Prices don't always go up, and they don't escalate to this degree. There'll be more choice at the end of the year, but there'll probably also be a price increase between now and the end of the year. Now, people ask me, should you wait or go now? That's a personal call. If you're renting and you can't find rental accommodation and you got the money, then buying and securing something is often well worth it. But if you wanted to have more choice and you aren't seeing the choice that you would like to see, or the range of properties that you'd like to pick from, waiting is worth doing. But in both cases, they're best. We haven't talked about this, Jayden, but that's why we work together, because we know how we think. And I think it's prudent advice that you need to sit down with somebody like Jayden and actually say, let's get our ducks aligned. Let's find out what we can borrow, the terms that we can borrow. So when we go make an offer, particularly now, but also into the future, we can make a hard offer. We can offer it cash, subject to pest and building, the usual things you do. And we know that we've got the money. Cash these days doesn't mean here's I'll open my checkbook and write you a check. It means that I can actually do that, not subject to finance. So if you know that you can spend $600,000 and you've got the deposit to do it, you can go in there and make a hard offer at that price, or a little less than that, subject to what you think the property's worth, rather than trying to make it subject to sale, this, that, and the other. Because at the moment, particularly, you won't get an offer. You won't get a look in. You'll have to go in there hard. And some people who even are selling now and the market's rising, they will take a 14 or 21 day unconditional contract subject to pest and building over one that's subject to sale or something like that. So you've got some negotiating, but not as much as you used to. But the key thing is to, if you haven't done it, is to see somebody like Jayden, only Jayden, and know what you can do, and then you've got in a lot stronger negotiating position. So my summary is that market's quite strong. It's likely to increase for the next period of time. If that increases too much, then you will see it overshoot, and when it overshoots, you'll see a contraction in value. I suspect that contraction in value will be less than the increases we've seen since October this year to say the October at the end of this year. So waiting is not necessarily for the average property, for the median type property, it's not going to be worth it. But after that, you're going to see a period of not much happen. So you're going to have a lot more choice. So if you're an investor or you're an owner occupier and you want to do it again, then into the medium term, you're going to have a lot more choice in the market. So that's me in a nutshell. Good looking. And we'll go to the last one. So go to the last one, which I pressed, but it's not moving. You've taken control of the slides. You'll have to move.
There we go.
Okay. So listeners, I've been doing this 30 odd years, 23 years under my own stream. I have a website like we all do. When I first started this, I had a website and people thought it was fantastic that I had a website, but it's choosing my last name, matusik.com.au. Go there, sign up if you don't get my missives, they're free. My website works like social media, so you can scroll through the previous posts, you can search wages and see what I've written and so forth. I do run some master classes. I know it's a bit of a wanky name, but somebody called them master classes 5-7 years ago, and I said, okay, let's stay with that. I've got 2 coming up, one's in June and one's in September. I like to do them live. There's only 25 people in a room. Both of these will be at the Regatta in Brisbane. One's on a Thursday, one's on a Friday. And we have lunch afterwards. I don't pay for your lunch, but we have lunch afterwards, and that often is quite good. Now, people have gone to those master classes and done business together afterwards because it's a very interactive session. Jayden's been to one of these in the past, and they're pretty cheap. They're $250, and we're there for a full half day, and we cover things like this, but it's a Q&A round table, and it works live, so they're worth doing. And there's a series of reports called Ready Reckoners on the website. Whilst I'd like your money, don't buy them yet. Wait for 2 weeks because they're being updated, and they have 6-month shelf life, and that will tell you the size of markets, what's happening in places like Logan, Ipswich, Moreton. I largely just focus on Southeast Queensland. I can write them for on a commission basis, and I do that in the state particularly, but half my audience is based in Southeast Queensland, so I largely write to that half of the audience. And they just tell you things that the real estate agent doesn't want to tell you, basically. I'm not into picking winners, they buy in this suburb. I don't believe that. I believe you can buy a property well in any suburb if you know what you're buying. You buy it for the right reasons and you pay the right price under the right contract conditions. So I'm not into picking winners like that, but it'll tell you what's happening in those markets along the lines of what we've talked about nationally here. That will be in the local market context. But the first thing you do is, if you're not getting it, go to my website, sign up for free. Something comes out every Tuesday at 8 o'clock. I repost it on Saturday morning if you didn't open it up. And my open rate's 50-odd%, which is very good for a business type email. So I'm proud of that. And obviously people read it, including Jayden, who bothered me now. I've liked doing Not Much in Tasmania. No. Thanks very much. Thanks for listening. And thanks, Jayden.
No, thanks for your time.